Imagine waking up one morning to discover that a company once praised as the smartest corporation in America has vanished almost overnight. Its executives were celebrities. Its stock was a darling of Wall Street. Its employees believed they were working at the future of capitalism itself. And yet, behind the glass towers and glowing analyst reports, something was profoundly wrong. The mystery is not just how Enron collapsed, but how so many brilliant people, powerful institutions, and trusted systems all failed at the same time. How could one company convince the world it was creating value while it was actually hiding losses, manufacturing profits, and hollowing itself out from the inside? To understand the Enron scandal is to confront an uncomfortable possibility that the greatest financial disasters do not begin with obvious villains or clear crimes, but with stories that sound too smart, too innovative, and too good to question. To see how this happened, we have to go back before Enron became a symbol of corporate fraud and before its name became shorthand for deception. We have to return to a time when Enron was not a scandal, but a promise. In the late 20th century, America was obsessed with deregulation, efficiency, and financial innovation. Old industries were being reinvented, and energy was no exception. For decades, natural gas and electricity had been heavily regulated, their prices and markets controlled by government rules. But as deregulation gained momentum, a new idea took hold. Energy could be traded like stocks or bonds, bought and sold in markets that rewarded creativity and risk-taking. This was the world Enron stepped into, and at first, it seemed perfectly designed for success. Enron itself was born from a merger. In the mid-1980s, two pipeline companies combined to form a new entity, headquartered in Houston, Texas. At the center of this new company was Kenneth Lay, an economist with deep connections in Washington and a firm belief in free markets. Lay believed that deregulation would unlock enormous opportunities in energy trading, and he positioned Enron not just as an energy producer, but as an intermediary, a market maker, and eventually something much more ambitious. Under Lay's leadership, Enron began to transform itself from a dull pipeline operator into a bold financial innovator. The transformation accelerated when Jeffrey Skilling entered the picture. Skilling was a former consultant with a sharp intellect and an unshakable confidence in complex financial models. He believed Enron should not think of itself as an energy company at all, but as a trading firm that happened to deal in energy. His most revolutionary idea was something called mark-to-market accounting. In theory, this accounting method allowed Enron to record the estimated future profits of long-term contracts immediately, rather than waiting years for the cash to actually arrive. If Enron signed a 20-year energy deal and projected massive profits over its lifetime, those profits could be booked on day one. On paper, this made Enron's earnings soar, quarter after quarter. The company reported strong growth, even when cash flows told a different story. The more deals Enron signed, the more profits it could recognize instantly, as long as the assumptions behind those projections remained unquestioned. Analysts loved it. Investors loved it. And internally, it created enormous pressure to keep the deals coming, no matter how risky or unrealistic they might be. As Enron's stock price climbed, so did its ambitions. The company expanded beyond energy into broadband, water, weather derivatives, and almost any market that could be turned into a tradable commodity. Enron promoted itself as a pioneer of a new economy, one where information and financial engineering mattered more than physical assets. Its executives spoke the language of innovation and disruption years before those words became clichés. To work at Enron was to believe you were part of an elite experiment in capitalism's future. But beneath this glossy surface, cracks were forming. Many of Enron's ventures were not generating real cash. Some lost money almost immediately. Others never came close to their optimistic projections. The problem was that Enron could not easily admit failure. Once profits had been booked up front through mark-to-market accounting, Reversing them would mean acknowledging that earlier numbers were wrong. And that, in a company obsessed with its stock price, was unacceptable. This is where the story takes a darker turn. To hide mounting losses, Enron turned to increasingly complex financial structures. Special-purpose entities, partnerships that existed mainly on paper, were created to move debt off Enron's balance sheet. These entities had names that sounded harmless or even whimsical, but their purpose was deadly serious. They allowed Enron to transfer failing assets and liabilities elsewhere, making the core company appear healthier than it truly was. At the center of this machinery was Andrew Fastow, Enron's chief financial officer. Fastow helped design and manage many of these special entities, blurring the line between corporate finance and outright deception. In some cases, he personally benefited from managing the partnerships that were supposed to protect Enron. Conflicts of interest multiplied, but they were rationalized as necessary innovations in a hyper-competitive market. What made this system especially dangerous was that it depended on Enron's stock price continuing to rise. Many of the off-balance sheet entities were backed by Enron shares. As long as the stock remained strong, the structures held together, but if the stock fell, the guarantees would collapse, forcing Enron to recognize massive losses all at once. The company was, in effect, betting its survival on its own stock performance, a circular logic that turned volatility into an existential threat. Inside Enron, the culture reinforced these risks. Employees were ranked against one another in a brutal performance review system that rewarded short-term gains and punished caution. Those who questioned the accounting or the sustainability of the business model often found themselves sidelined or pushed out. Success was measured in deals closed and profits reported, not in long-term stability or ethical restraint. Over time, skepticism became career suicide. Outside the company, warning signs were missed or ignored. Investment banks earned lucrative fees structuring Enron's deals and had little incentive to challenge its practices. Rating agencies relied heavily on information provided by Enron itself. Auditors, including one of the most respected accounting firms in the world, signed off on financial statements that were increasingly disconnected from economic reality. The system of checks and balances that was supposed to protect investors instead amplified the illusion. The breaking point came when reality could no longer be postponed. As energy markets shifted and some of Enron's trades went bad, cash shortages became harder to hide. Questions began to surface about how the company actually made its money. A few journalists and analysts started to dig deeper, asking why reported profits did not match cash flows. Inside the company, a whistleblower warned top leadership that the accounting practices could lead to collapse. The warning was largely ignored. When Enron's stock price finally began to fall, the consequences were immediate and catastrophic. The off-balance sheet structures that depended on a high share price unraveled. Losses that had been hidden for years surged back onto Enron's books. Confidence evaporated. Credit ratings were downgraded. Trading partners demanded collateral that Enron could not provide. In a matter of weeks, a company once valued in the tens of billions was fighting for survival. The end came swiftly. Enron filed for bankruptcy, at the time the largest corporate collapse in American history. Thousands of employees lost their jobs and, in many cases, their retirement savings, much of which had been invested in Enron stock. Investors lost billions. The image of Enron as a beacon of innovation was replaced by images of empty offices and shredded documents. The fallout was not limited to one company. The scandal shook public trust in corporations, markets, and accounting itself. Arthur Andersen, Enron's auditing firm, was convicted of obstruction of justice for its role in destroying documents related to the audit, effectively ending a storied firm that had once stood as a pillar of the profession. Executives were prosecuted. Jeffrey Skilling was convicted on multiple counts and sentenced to prison. Andrew Fastow also went to prison after cooperating with investigators. Kenneth Lay died before his case could be resolved, leaving lingering questions about accountability at the very top. In response, Lawmakers promised reform. New regulations were introduced to strengthen corporate governance, improve transparency, and hold executives accountable. The most famous of these reforms aimed to prevent the kind of accounting abuses that Enron had perfected. Companies were required to disclose more information, auditors faced stricter oversight, and executives had to certify the accuracy of financial statements. On paper, the system was fixed. And yet, the deeper lesson of Enron is not about one set of rules or one flawed accounting method. It is about how narratives can overpower reality. Enron sold a story of innovation so compelling that it silenced doubt. Complexity became a shield, discouraging outsiders from asking simple questions. Success created credibility, and credibility reduced scrutiny. These patterns did not end with Enron. In the years since, markets have seen repeated echoes of the same dynamics. Financial crises fueled by opaque instruments, incentives that reward short-term gains, and institutions deemed too sophisticated to fail have appeared again and again. Each time, the details differ, but the structure is familiar. Confidence rises faster than understanding. Risks are hidden rather than eliminated. When the system finally breaks, the damage spreads far beyond those who designed it. The Enron scandal also forces us to confront an uncomfortable truth about intelligence and ethics. Many of the people involved were not ignorant or careless. They were highly educated, deeply experienced, and convinced of their own brilliance. Their downfall was not a lack of knowledge, but a belief that cleverness could replace integrity, that models could substitute for reality, and that rules were obstacles to be managed, rather than safeguards to be respected. As the dust settled, 3 lessons emerged with painful clarity. First, complexity is not the same as value. When a business cannot clearly explain how it makes money, that is not a sign of sophistication, but a warning. Second, incentives shape behavior more powerfully than intentions. A culture that rewards short-term performance will eventually sacrifice long-term stability, no matter how noble its mission statements sound. Third, transparency is not optional. Markets cannot function without trust, and trust cannot survive sustained deception. The story of Enron is not just a historical case study. It is a mirror held up to modern capitalism. As new technologies, financial products, and business models emerge, the temptation to believe in effortless growth and genius solutions remains strong. The question is whether we have learned to ask harder questions, or whether we are once again mistaking confidence for competence. Because somewhere, right now, another company may be telling a story that sounds revolutionary, reporting numbers that look extraordinary, and promising a future that seems just within reach. The real challenge is not predicting which company will fail next, but deciding whether we will recognize the warning signs when they appear. If you want to understand the forces that shape our financial world, the incentives that drive corporate behavior, and the hidden risks behind headline success, stories like Enron matter more than ever. If this deep dive helped you see those patterns more clearly, consider subscribing, sharing your thoughts, and continuing the conversation. The next scandal will not announce itself in advance, but the lessons are already written for those willing to listen.